Well, South African chemical maker Omnia's full-year headline earnings per share ticked up by 25%. That's to 958.6 cents, boosted by higher sales in its mining and agricultural business. Joining us now to take a look at the numbers, Rod Humphris, Managing Director of Omnia. Rod, thank you so much for joining us on Power Lunch today. Well, a record year for the company in terms of profits. So, you know, you're doing something right. 39% growth in profits, 629 million rand. Run us through the key drivers for the period.
Look, I think it was a great result, particularly in a year just before our new plant came on stream, because we really expected some margin compression, and in fact we did see that in an agricultural business, because that was the year that we're going to be most short of our nitrate raw material. But we've come through it pretty well, and the new plant is on stream.
Okay, well, before we get into the new plant and then what that means for the company, what that means for South Africa, just let's run through the various divisions. Mining doing very well, revenue up there by 46% rather, operating profit up by 53%, strong margins coming through. So how do you capitalize on the growth that you're seeing there? Is this kind of the type of growth that you can sustain, or is this a year that is just record profits coming off perhaps a lower base?
Look, I think we've seen some good growth in mining for the last few years, and this year has been quite exceptional. But having said that, going forward, we would really expect some good growth coming through. I think there's many prospects in Africa which are currently being developed, which is maybe counterintuitive to some of the gold and platinum woes. But the other minerals are developing really well, and we're certainly being able to capitalize on those opportunities.
How do you have touch points in Africa to capitalize on that? Are you growing your presence in Africa, sending more personnel there, sending kind of more bricks and mortar presence to African economies?
Yes, absolutely. We're based now in some 26 countries in Africa. So we have people on the ground, and of course they're very close to the action and are able to pick up new opportunities as and when they come about.
In terms of capital though, in terms of time spent on that, where are you spending majority of your energy with regards to your African touch points?
Well, really I think West Africa is quite a strong growth point, but so is Southern Africa. You know, Southern Africa continues to grow in many areas. The copper business up in the copper belt in Zambia, DRC is good. Uranium business in Namibia continuously expands. And there are a number of other areas of iron ore, diamonds, nickel, and coal mining here in South Africa, which is growing strongly.
You mentioned the agricultural part of your business, top line sales growth there coming in to 27% to 3 billion rand, but margin compression is one of the factors that is overall impacting on the bottom line of the company. So how do you translate the strong growth in revenue into bottom line performance?
As soon as this new plant comes on stream, as I said, the margin compression there is solely due to us having to buy much more expensive nitrates in the year where our shortage was the most acute. So with the startup of the new plant, we've addressed that issue, and we would expect our margin to go back to normalized levels, and in fact we are suggesting slightly higher than normalized levels, as we have to give a good return on the money spent to our shareholders.
And of course, you've been able to resume a dividend this year, so you are returning to your shareholders earlier than anticipated. Tell us about this nitric acid plant complex, because this is important not only to Omnia but to South Africa.
Yeah, no, absolutely. You know, the new plant that we've put in is some 40% bigger than our existing plant, and the existing plant will continue to operate, and in fact is still in very good shape. So from our perspective and our customers' perspective, we have a lot more security of supply, reliability. The plant is bigger than our immediate needs, so we will grow into the market as the market grows. So you know, we're really well set in being able to supply a raw material into our conversion processes downstream. And in fact, the benefit will then flow through, because our conversion processes downstream have not been running at full capacity due to our upstream shortage. So this will really assist them in being able to utilize their fixed costs better.
You mentioned not running at full capacity. I mean, what does that mean in terms of percentage levels?
No, look, I mean, clearly this plant is a 40% larger capacity than our existing plant. So there's a considerable increase in the quantities that we would be producing downstream.
The chemicals business, of course, has been an underperformer when it comes to sales growth. Sales growth falling back by 5%, and of course margins very low on this part of the business, only 2.5%. You are targeting 4.5% to 5.5% when it comes to your operating profit margin. How do you turn the chemical side of the business around, and what is that geared towards?
Look, it has been a difficult area. You know, the customer base there is in the manufacturing side of South Africa. And it has been a difficult environment, and I think remains a difficult environment in which to operate. The volume drop there was primarily due to us taking a deliberate decision to drop down some of our polymer businesses and change the reward risk ratio somewhat. But having said that, we've spent a lot of time in focusing on costs and operating efficiencies, and I think we've made great strides in that area, and we're starting to see the benefit of that kicking in.
Can you get volume growth though coming through? Because of course you're looking at the cost side of the business. So how do you get that volume growth, that top line growth?
No, I think we're now starting to focus once again. We've got the business a lot leaner and meaner than where it was. And going forward, the focus will be on volumes, new products, new principles, and we already see some signs of those coming through.
So last year, July, you mentioned the fact that organic growth and cost reduction can only go so far in terms of fueling growth at Omnia, and you talked about acquisitive opportunities in the market. So have you got your eyes set on anything?
No, look, we continue to look for opportunities, but they have to be good value opportunities in order to strengthen our core businesses. So we're working on those, but it's not a priority. Certainly there's a lot of organic growth coming through in the company, and the most immediate concern is to make sure that new plants generate the kind of returns that shareholders would expect.
So what is the next period for Omnia going to entail? Because of course you mentioned the nitric acid plant coming online. Is that the key focus for you, or where are you putting most of your focus right now in terms of managing and continuing to generate that organic growth?
No, certainly. I think it's very important, having spent that sort of capital on this new complex, that we ensure that it operates properly, it operates at capacities, and that generates the return. So I think that's the primary focus. But of course, in going forward, we are looking at the various opportunities, and there are a number.
Outside of Africa?
We do have some.
Outside of South Africa, rather?
Certainly. I mean, we have an important part of our turnover. Some 25% of our turnover is derived from outside South Africa, and there are many opportunities which we're exploring outside of South Africa. We do have some smaller businesses in Australasia as well as in Brazil.